Elon Musk just said this is by far the most serious looming issue, mortgages too. At first, before reading the full sentence, I thought, oh, this must be Elon talking about AI again, but no, he's not talking about AI. That was Elon's reply to this. Over the next 5 years, more than 2.5 trillion in commercial real estate debt will mature. This is by far more than any 5-year period in history. Meanwhile, rates have more than doubled and commercial real estate is only 60 to 70% occupied. Refinancing these loans is going to be incredibly expensive and likely lead to the next major crisis. The worst part is 70% of commercial real estate loans are owned by small banks. You know, banks that are actually quite a bit smaller than Silicon Valley Bank. Yeah, so that's not great. Rapidly rising rates are teaching everyone a valuable lesson. There's no such thing as free money. Rapidly rising interest rates seem to be sending ripple effects throughout the economy. From the bank crisis to a commercial real estate crisis, the Fed plays a major role. Meanwhile, rates are still rising. I'm curious to learn more about what Elon thinks about the current state of our economy, and he actually said accurate about this clip from the All In podcast. Elon knows them pretty well because they are rich venture capitalists, and some of them actually worked with Elon directly.
Do they know what they're doing, and how could they do a better job?
No, I don't think they know what they're doing. They clearly reacted way too late to the inflation. We've talked about this before. We had that surprise inflation print in the summer of 2021, 5.1%. They said it was transitory. They didn't react until November. They continued QE for another 6 months. And they suddenly got hawkish in November of 2021, and they didn't even start the first rate increase until March of 2022. So they were really asleep at the wheel and late to react to the inflation by about 9 months.
The economist L. Arian actually went as far as to say that transitory was the worst inflation call in the history of the Fed. That caused so many issues. They overstimulated, they created this inflation basically, and now they are over tightening to overcompensate for that, but now perhaps they are going the other way too much. I understand the Fed wants to create stable prices because Jerome Powell says without price stability, the economy does not work for anyone. And while that is somewhat true, of course, if you bring the whole economy down, maybe you will have no one left in the economy. So who will the economy work for if there is no one left? I am, of course, being a little bit silly, but still, what the Fed is doing right now is like, imagine going to a doctor and you're telling the doctor, my arm hurts. And then your doctor takes a hammer and hits your leg. And then asks you, how's your arm now? Doesn't hurt anymore, right? When inflation started rising, I personally was not happy that the interest rates were so low. I would have preferred that they increased these rates. And now they have to fight these problems that they create themselves with this short-term thinking. But they are solving these problems also with short-term thinking, possibly creating much bigger problems. Again, generally, increasing interest rates, I think, was not the wrong move here, having to work with what you had to work with, but they could have increased the rates at a slower pace, especially towards the end.
Now I think they're potentially making the opposite decision, which is they are late to recognize what distress the economy is under right now. And Powell had, there was 3 choices they could have made at this meeting. They could have raised rates, which is what they did. They could have cut rates, which they didn't, or they could have done nothing, basically held pat.
There was actually the 4th option, and the markets gave a somewhat decent probability of that happening, although a low probability, and that was to increase rates even more than by how much they increased. They increased by 25 basis points, but the market also said there was a small chance that the interest rates would go up by 50 basis points. At least they did not do that.
And the argument for raising rates is just that, well, we have this inflation problem. We need to keep raising interest rates until the rates are above inflation, and that will bring inflation down. Then you can start to lower rates. That's sort of the conventional view. I think the problem with that view is it ignores that we've just seen a run of bank failures, and there's tremendous stress building up in the banking system from unrealized losses on long-dated bonds, also unrealized losses on commercial real estate loans. And we've barely scratched the surface of seeing that problem. That's, I think, the next shoe to drop.
About a year ago, I was presented with an opportunity to acquire this wonderful piece of commercial real estate. And even looking back, yes, it was a wonderful piece of real estate. And this was back when the interest rates were pretty much at zero. I did all of my numbers, and everything made sense. It was a perfect opportunity. I was going to open my own business there, and the renovation was already done. That would have saved me $1 million. So even if I overpaid for that property a little bit, or if I bought it and it went down in value by quite a bit, I would have been perfectly happy still. For what I wanted to do, it's extremely difficult to find a renovation done perfectly. It almost never happens. And the size of a property was also perfect, as well as the location. I have been waiting for this for about 2 to 3 years, and finally it happened. But then I go to multiple banks, and the big banks, they want a pretty high down payment on that. And I'm like, yeah, well, I will need to take money away from, for example, Tesla stock, which I would rather just keep a lot of money in Tesla's stock. I would prefer a smaller down payment. So I go to the smaller bank, which was recommended to me by one of my developer friends, and they gave me terms that were somewhat reasonable, especially for a down payment. Yeah, the terms were pretty good actually. But here in Canada, for commercial properties, you can't really fix the interest rate for a very long time. So then I looked at what could possibly happen if interest rates went back all the way up to, let's say, 10%. Then I started struggling with that idea, because then I would basically be making no money probably from this whole thing. And here was the absolute scariest part about that whole thing. They explicitly told me, it wasn't just in a contract somewhere hidden on page 127 in paragraph C458. No, they basically explicitly told me that, look, if interest rates start going up a lot, and if your property declines in value, which if it's commercial real estate, it could, we will request probably a fairly big lump sum from you with perhaps a fairly short notice. But then they assured me that interest rates are not going to go up, so that's not going to be a problem. Yeah, I'm so happy I passed on that deal. It would have worked out, because for my business, it would have been such a perfect location, but it would have been stressful. And actually, I just checked, that property is still for sale 1 year later with much high interest rates, and they are still asking for the same price. So if I made an offer today, I am quite sure that they would give a much better price. But Tesla stock is still on a 50% discount, and if I got that property, I would have probably almost no time to make any videos for, I don't know, maybe a few months or longer. So I'm not going to make any offers. But oh boy, do I not envy all of the other people that will have to face some serious issues relatively soon, because they will have to refinance their commercial real estate debt at much higher interest rates than they expected.
I think that the right decision here was to either cut rates or to stand pat. You may have seen that Elon said, listen, we should be cutting rates here. There's way too much latency in this inflation data. The economy is seizing up, and we don't need to be raising rates right now. We actually need to be cutting them. I think that probably, if it were me looking at the upside downside of these decisions, I probably would have just stood pat, because again, we've just seen this banking crisis. Why wouldn't you just wait 1 month to see? Maybe there is latency in the inflation data. Maybe the banking crisis is not over. Why wouldn't you just stand pat for 1 month? You can always raise rates in a month. I think that this move here could, in hindsight, be seen as the straw that breaks the camel's back.
While just standing still might have created a little bit of a panic in the market, making it think that, oh, the banking crisis actually is much worse than we all thought, because the Fed is not increasing the rates, because they said they would increase the rates, but now they did not. But that's just the perception. The actual damage would have been a lot less than And also, with every inflation reading coming in lower than the one before, there really wouldn't have been much downside to wait just at least 1 month. And then, if inflation is still coming down based on your data, maybe you can just stay there even. But if it's not, just raise the rates then. You only lose 1 month. It's not going to change much other than potentially prevent a disaster from happening in the banking sector. And look at what James is saying here on Twitter. As I have been saying for years now, the chip shortage is why these automakers are saying they cannot make enough vehicles. But we are now learning that the automakers are purposefully limiting the supply, purposefully producing less vehicles to protect the residual value of their fleets given the massive implications on their financing divisions. Earlier this year, the Kia CEO admitted to controlling supply, which artificially boosts residual values. The used car prices are rising again after spending most of 2022 on a downward trajectory right here. Yeah. That just won't last long because of Tesla's price cuts. And you have to see this. This is the production of the Mach-E compared to the Model 3. The Mach-E is in blue. As you can see, the first production quarter, actually, Ford ramped up the Mustang Mach-E faster than Tesla ramped the Model 3, and that's still true for the second quarter, but no longer the third quarter. Somehow, the Ford Mach-E just stopped ramping. Good luck to Ford trying to deliver 2 million EVs in a year in 2026. And this is the Tesla stock buying opportunity explained by Elon Musk. My name is Matt Post. Just like and subscribe if you haven't yet, and I will see you in the next video. Thank you so much for watching.